Hey everyone, as we navigate a cycle of elevated inflation, one of the things I frequently mentioned was that commercial real estate offers some inflation resistance. This week, I wanted to put a little math behind that statement using the Pearson correlation coefficient, which basically measures how closely two metrics align with each other. Now, we did a 25-year correlation analysis of rent growth versus inflation for 5 of the 6 property types I'm going to highlight today. For self-storage, we can only do an 8-year analysis. It just has less information available. We had one major inflation surge in that span, but inflation did rise to the 4.5% range on several occasions during the 25-year analyses, and the statistical correlation picks up those inflation cycles. That said, we have to remember that there are, of course, other forces in play that influence rent growth, like new construction, economic trends, and behavior changes. But the historical correlation between rent growth and inflation is still useful. In addition, my point here is not that inflation causes rents to go up. It's more likely that the events driving inflation higher also drive up rents, either directly or indirectly. And as an investment baseline, I compared the results with the S&P 500. Based on our calculations, the S&P 500 had a 16.8% correlation with inflation, which is low. We ran the math using some other methodologies and actually got a negative correlation between the S&P 500 and CPI inflation. That suggests that depending on the exact way you calculate the quarterly S&P value, the stock market may fall when inflation rises and vice versa. But I'll use that 16.8% as our baseline since we calculated it the same way we calculated the rent growth correlations. So with that said, I'll start with the property type that has the least alignment between inflation and rent growth. That's office properties, which have a 15.9% correlation. Basically, it has very little correlation. That's likely driven by 2 factors. First, office leases tend to be very long, 5 years or longer, and they may or may not have inflation adjustments built into the lease terms. Second, office property demand has been dramatically impacted by hybrid schedules and working from home in the post-COVID era. So for the last 5 years, office rents have not moved much on an aggregate national average basis. The next property on the list is retail, with a 39.4% rent growth to inflation correlation. So retail rent growth tends to rise with inflation, but only to a modest degree. Again, retail leases tend to be long, so the rents aren't necessarily going to move with inflation, but retail property leases are more likely to have built-in rent escalators than office properties. So the correlation between inflation and retail rent growth is stronger. The third property type is industrial, with a 49.2% correlation. Many industrial properties have built-in rent escalators that are either at a fixed increase or move with inflation. So industrial rents have a moderate correlation with inflation, and based on our calculations, about 24% of industrial rent growth is tied to inflation. The next property is self-storage, with a 51.3% correlation. Generally, self-storage leases are month-to-month, but sometimes they're annual. And although it's easier to move self-storage rents with inflation, other forces like the pandemic, waves of elevated construction, and the use of discounted street rates likely influence the results. In addition, as I mentioned earlier, we have less self-storage rent growth data to work with. Our data only goes back to 2018, so the calculation is based on 8 years of data instead of 25. The second strongest correlation between rent growth and inflation is apartments, with a 63.1% correlation rating. That's a pretty strong positive relationship. Because apartment leases are usually annual, they tend to adjust with inflation. Based on our calculations, about 40% of apartment rent growth is associated with inflationary pressure. And the property type with the strongest correlation between rent growth and inflation is, of course, hotels at 65%. Hotel rents adjust daily, so they can adapt to inflationary pressure very quickly. Based on our math, about 42% of hotel rent growth is tied to inflationary pressure. So, as I mentioned earlier, there are, of course, a lot of forces in play. The flow of development and new supply can be a factor, as can economic forces, job creation, demographics, behavior changes, and so on. But over the long haul, commercial real estate can offer more inflation resistance than other investment types. If the S&P 500 has a correlation of 16.8% or possibly even a negative correlation with inflation, then the stronger alignment offered by the rent growth of industrial properties, self-storage, apartments, and hotels may be particularly appealing in the current economic climate, especially if inflation continues to rise and the climate extends into 2027. In addition, diversifying a portfolio to include commercial real estate can offset some of the risk and volatility of other investment classes. And that's something investors need to consider as they keep their eyes on the horizon.